They officially beat consensus across the board. AstraZeneca's first half 2026 numbers just dropped, and total revenue hit $30.67 billion.
Right, which is a 6% increase at constant exchange rates. And core earnings per share jumped 11% to $5.21.
Yeah, and Q2 core gross margin expanded by a full percentage point to 84%. Plus, management reaffirmed their full-year 2026 guidance.
Exactly. They are still projecting mid to high single-digit revenue growth and low double-digit core EPS growth.
And the market clearly liked what it saw. The stock popped about 3% in early trading right after the report hit the wire.
I mean, when you post a beat like that on both the top and bottom lines, the market is going to reward you.
So you are listening to a deep dive into AstraZeneca's H1 and Q2 2026 earnings report. Our mission today is to tear apart those headline figures for you, the retail investor. We're looking under the hood at the underlying segment performance, the margin mechanics, and, the specific risks driving this pharmaceutical giant right now.
Because when you see that $30 billion figure, it's really easy to just assume everything is moving up. But a global pharma company operates a lot more like a massive holding company.
Right.
You've got totally distinct divisions relying on different science, and they face entirely different economic pressures.
Well, let's start with the divisions that are actually doing the heavy lifting, because the growth engines right now are unequivocally oncology and rare disease. If we look at the raw data, oncology brought in $14.1 billion in just the first half.
Yeah, which is a massive 15% growth rate.
Right, 15%. And for a division of that size to grow at 15%, you need more than just one lucky drug.
Oh, absolutely. You need systemic success across multiple indications, and that is exactly what we're seeing here. I mean, the absolute standout is in HER2, which is up 31% to $1.7 billion.
Wow.
Yeah, and the report notes this is largely driven by really strong global demand in breast cancer, specifically HER2 positive and HER2 low metastatic breast cancer.
Okay, so I see those terms all the time in these reports. But for an investor who doesn't have a medical degree, what does HER2 low actually mean for the drug's market potential?
So to understand the revenue, you really have to understand the mechanism. HER2 is a protein that basically promotes the growth of cancer cells.
Okay.
Historically, treatments could only effectively target tumors that had really high levels of this protein, the HER2 positive patients. If a patient had lower levels, those targeted therapies just wouldn't work.
Got it.
But Enhertu is what we call an antibody-drug conjugate, or an ADC.
In ADC, right? I mean, you hear that acronym thrown around like it's the new holy grail in oncology.
It kind of is, honestly. Think of an ADC like a microscopic guided missile. It basically has two parts. The first part is the antibody, which acts as a targeting system. It hunts down those specific proteins on the cancer cell.
And that second part?
The second part is the payload, which is the actual chemotherapy drug. Because Enhertu has this incredibly sensitive targeting system, it can attach to cancer cells that have very low levels of that HER2 protein.
Oh, I see.
Yeah, and then it delivers the chemo directly inside the cell without, carpet bombing the patient's healthy tissue.
Right, so by proving it works in HER2 low patients, AstraZeneca essentially just unlocked a massive, previously untapped demographic.
Exactly. They vastly expanded their total addressable market.
Which completely explains that 31% surge. I mean, they aren't just stealing market share from competitors. They are literally creating a new market out of patients who didn't have options before.
Yeah, and they're applying that same precision strategy across the whole oncology portfolio. Like the report highlights Imfinzi, which is up 27% to $3.5 billion.
Right, led by the gastrointestinal and genitourinary launches.
Exactly. And then you have TrueCop, which surged 37%. It hit peak share in second-line biomarker-altered metastatic breast cancer.
Wait, biomarker-altered? That's another one of those crucial buzzwords for investors, right?
Yeah, definitely. It means the medical community is moving away from treating breast cancer as just one single disease. Now, doctors take biopsies. They test the tumor's DNA for specific genetic mutations, the biomarkers, and then prescribe a highly targeted drug like TrueCop designed just for that mutation.
Which yields better clinical outcomes, and I imagine that translates to incredibly sticky market share.
Incredibly sticky. Once a targeted drug works for a specific mutation, doctors are very hesitant to switch.
Well, even their older foundational oncology drugs are still grinding out gains. Tagrisso got a 6% bump, but, When we look at the rare disease division, the strategy is completely different.
Oh, totally different.
Yeah, it's less about finding new patients and more about aggressively migrating the ones they already have.
Right, so rare disease grew 11% to 4.9 billion, and the entire narrative here revolves around just two drugs, Soliris and Ultomiris.
And the numbers on those two are fascinating. The newer drug, Ultomiris, grew 14% to 2.58 billion. But then the older one, Soliris, dropped 22% down to 778 million.
Yeah, on paper, it looks like one is succeeding and one is failing, but the report makes it very clear that this is deliberate. It's a managed cannibalization of their own product line.
Right, because both of these are C5 complement inhibitors. Correct.
Yes. They're used for ultra-rare severe conditions, things like generalized myasthenia gravis. Essentially, the patient's immune system becomes overactive and attacks their own healthy cells. These drugs inhibit that C5 protein to stop the destruction.
But if they effectively do the same thing, why is the company working so hard to kill their own sales of Soliris just to push Ultomiris?
Simple answer: patents.
Hmm.
Soliris is losing its patent protection. It is facing immediate, intense pressure from biosimilars.
And a biosimilar is basically the generic version of a complex biologic drug.
Exactly. And once a biosimilar hits the market, the price just collapses.
Okay, I look at this dynamic sort of like a telecom company. Imagine you have millions of customers on a highly profitable 3G network. But you know a discount competitor is about to launch their own cheap 3G network and steal everyone. So instead of waiting for that, you proactively spend a fortune building a 5G network, and you aggressively move all your customers over to it, locking them into new contracts. Your 3G revenue plummets? Sure, but you keep the customer base.
That is the exact economic principle. In pharma, it's always better to eat your own sales with a newer, longer patented drug than to let a competitor do it. But to make that transition work, your new 5G network actually has to be better.
Right, you can't just force doctors to switch medications without a real clinical reason.
Exactly. So Ultomiris was engineered to have a significantly longer half-life in the bloodstream than Soliris.
Meaning it just stays active in the body longer.
Yeah. For the patient, Soliris requires an IV infusion every 2 weeks. Ultomiris only needs one every 8 weeks.
Oh, wow. That is a massive quality of life improvement.
It's huge.
Yeah.
And that clinical advantage is the only reason the cannibalization strategy works.
But I do have to point out the risk factors in the text. The report explicitly warns about increasing biosimilar pressure on Soliris in the US and Europe. Can Ultomiris really catch all those patients before competitors scoop them up?
I mean, the 11% segment growth suggests they're pulling it off for now, but the pressure is relentless. The moment a cheaper biosimilar is available, insurance companies exert massive pressure on doctors to prescribe the cheaper option.
Right. They don't want to pay the premium for Ultomiris if they don't have to.
Exactly. So this whole division relies on AstraZeneca defending the clinical superiority of that 8-week dosing schedule.
So they are essentially fortifying their position, buying themselves time, but they're going to need every second of that time, because if we pivot to the cardiovascular, renal, and metabolism division, the CVRM portfolio, we see what happens when a company actually runs out of time.
Yeah, this division is the anchor drag on the entire report. CVRM fell 12% down to 6.1 billion.
And the report points the finger at two specific acronyms, LOE and VBP, loss of exclusivity in the U.S., and value-based procurement in China.
The financial damage here is pretty brutal.
It really is. Farxiga, which has been an absolute foundational blockbuster for them, dropped 11% to $4 billion due to U.S. generics launching in Q2. And then Brilinta fell a staggering 66%, down to just $186 million.
66%. Just let that sink in.
It's a crater.
Yeah.
Now, to be fair, Lokelma grew 26% in that same division, but that's a drop in the bucket compared to the massive holes left by Farxiga and Brilinta.
Well, to understand why a 66% drop happens so fast, you have to look at the mechanics of loss of exclusivity. When a drug is under patent, you have a legal monopoly. You control supply, you control price.
But the expiration date is public knowledge.
Right. Competitors aren't just waking up on expiration day and saying, hey, let's make a generic. They've been waiting at the gates for years.
They have the formulas ready, the regulatory approvals tentatively lined up.
Exactly. The literal minute the patent expires, multiple generic manufacturers flood the market all at once. And because they didn't spend billions on R&D, they compete purely on price.
So the cost craters.
Sometimes by 80 or 90%. And pharmacists are usually legally mandated to substitute the cheaper generic. So AstraZeneca loses massive market share almost overnight. It's not a gradual decline. It is a literal cliff.
Jeez. Okay, so I get how a U.S. patent cliff destroys revenue,
Yeah.
but the report also heavily blames China's value-based procurement program. How does a government purchasing program destroy margins if the actual patient demand in China is still really high?
Well, VBP is basically a national bulk purchasing mechanism. The Chinese government leverages its massive population to force price concessions. They tell pharma companies, we will guarantee you millions of patients, but you have to slash your unit price to the absolute floor.
So it's a race to the bottom. If you don't offer the lowest price, a local generic manufacturer wins the contract and you get locked out of the market.
Yep. And if you do win the contract, your margins are just decimated. You're suddenly shipping millions of pills for a fraction of the profit you made a year ago. It drags down the top line revenue, even if your volume is way up.
So looking at those massive craters in CVRM, I really have to push back on management's long-term forecast. CEO Pascal Soriot is still targeting $80 billion in total revenue by 2030.
He is.
From a retail investor standpoint, how on earth do you bridge the gap between this current generic bleed and that massive 2030 target? I mean, it's a leaky bucket. How do you fill a bucket that has such a massive hole in the bottom?
Well, management is definitely aware of the math. In the report, when Soriot reaffirmed that 80 billion ambition, he added a very grounded caveat. He said the path assumes successes and setbacks.
And we definitely saw one of those setbacks in this very report, the Cardio-T Transform trial.
Right, for the drug Wainua. They were testing it as a monotherapy for a severe heart condition, and it missed its primary endpoint.
When a late-stage phase 3 trial misses a primary endpoint, what's the actual financial hit for the company?
It means the years of capital poured into that trial are effectively zeroed out. Regulators won't approve it for that specific indication, so you have to completely erase all that projected revenue from your future financial models.
That's a heavy blow. But they did have successes too. The report highlighted 6 key positive phase 3 readouts and 8 major market approvals, like Baxfeni for hypertension in the U.S.
Which is notable because it's a first-in-class medicine.
Right. But relying purely on internal science is risky. So to plug that leaky bucket left by Farxiga, they are spending heavily on M&A.
The scope of their external spending right now is a critical takeaway.
Yeah, just this quarter, they paid $600 million upfront to Dizal Pharmaceutical for Zegfrovy, a lung cancer drug, and another $200 million upfront to Sino Biopharmaceutical for a respiratory asset. And remember, for anyone listening, those are just the upfront cash payments. There are billions more tied to future milestones.
This is exactly how you attempt to guarantee you hit that 80 billion mark.
But I have to ask about capital allocation. Are these targeted acquisitions costing $800 million in cash this quarter alone? Is that a sign of management panic over the patent cliffs?
Looking at the broader balance sheet, this really leans toward healthy portfolio maintenance, not panic. I mean, they ended the half with nearly $5 billion in cash and equivalents and $9.8 billion in total financial resources.
So they have the war chest for it.
Easily. And look at what they bought: a lung cancer drug and a respiratory asset. These plug perfectly into their existing dominant commercial infrastructure.
Okay, that is the real aha moment of this report for me. AstraZeneca isn't just buying drugs, they are outsourcing their R&D risk.
Exactly.
They let smaller biotechs take on all the massive early-stage risk of finding a molecule. Once the science is somewhat proven, AstraZeneca steps in, buys the rights, and uses their massive global sales network to distribute it.
It's highly efficient. You pay a premium up front, but you avoid funding a decade of early-stage clinical failures.
But running those late-stage global trials still costs a fortune. Let's look at expenses. Core R&D expense increased 6% to $7.1 billion for the half.
Which is the unavoidable cost of funding those massive phase 3 trials.
Right. And core SG&A selling, general and administrative, also rose 6% to $7.9 billion.
Reflecting the costs of launching new drugs and pushing blockbusters like Enhertu into new markets.
Makes sense. But there's a really interesting margin mechanic I want to dig into. Despite gross margin expanding to 84%, the report specifically notes that profit-sharing arrangements are dragging that number down.
The accounting here is vital for investors to grasp. For those massive ADC drugs like Enhertu, AstraZeneca didn't develop them alone. They partnered with the Japanese pharma company Daiichi Sankyo.
Right.
So when AstraZeneca records the sales in certain markets, it boosts top-line revenue. But they are contractually obligated to pay a massive share of the gross profits back to Daiichi Sankyo. That payment goes into the cost of sales line, which mathematically lowers the reported gross margin percentage.
It's kind of like splitting the check at a really expensive steakhouse.
Yeah.
You get the prestige of eating the prime rib, which is the massive top-line sales, but you're contractually bound to give away half the profit to the partner who brought the wine.
That's a great way to look at it.
So from an investor standpoint, are these profit-sharing structures actually better for the bottom line than just funding it internally and keeping 100% of the profit?
In modern oncology, almost universally yes. The sheer capital required to run these trials, plus the high rate of clinical failure, makes going it alone incredibly dangerous.
It's just too much risk for one balance sheet.
Exactly. By partnering with Daiichi Sankyo, they de-risked the development and got access to revolutionary technology they didn't even invent. Yes, you share the profits on the prime rib, but if the phase 3 trial completely fails, you only absorb half the catastrophic loss. Mitigating downside is just as important as maximizing upside.
That makes perfect sense. And speaking of mitigating risk, let's briefly touch on the legal liabilities. The report notes the ongoing 340B antitrust litigation in the U.S.
Yeah, involving disputes over contract pharmacy discounts and government pricing. AstraZeneca is seeking review by the Supreme Court after an appeals court ruled against them. It's a contingent liability, so it could potentially impact future cash flows.
But they did officially clear one hurdle. The U.S. Supreme Court denied review on the University of Sheffield contract dispute over Lynparza, so that legal matter is closed.
Which is always a quiet victory. The fewer contingent liabilities you have, the easier it is for investors to model future cash flows.
Now, let's pull all this data together. If you're trying to synthesize this massive report, here's the core narrative. AstraZeneca is executing a high-wire portfolio transition. The precision-driven growth in oncology, plus that aggressive patient migration strategy in rare disease, is successfully masking the generic-driven bleed in the CVRM division.
They're using the cash generated by their current winners to aggressively purchase their future through M&A and internal pipeline development.
Which is keeping them on the path to that 2030 ambition. But I want to leave you, the listener, with a final provocative thought based on a detail buried deep in this report. In Q2, AstraZeneca paid $1.2 billion upfront to CSPC Pharmaceuticals. But they didn't buy a drug. They bought access to an AI-driven peptide drug discovery platform.
Dropping $1.2 billion on a tech platform instead of a clinical asset is a staggering allocation of capital.
It is, and it raises a massive question. The whole financial model of this industry relies on the patent cliff. You discover a drug, you get a decade of exclusivity, and then generics wipe you out. But if artificial intelligence can drastically shrink the timeline and cost of discovering new molecules, does the dreaded patent cliff even matter in the next decade?
It's a fascinating paradigm shift. If you can use AI to instantly generate a superior replacement drug, the generic threat really loses its teeth.
Exactly. If discovery drops from 5 years to 5 months, it rewrites how the market values these companies entirely. Definitely something to mull over as you analyze the long-term viability of your healthcare portfolio. And hey, if you want to keep cutting through the noise and understanding the mechanics behind these numbers, follow the show for daily earnings coverage.